Hey folks, welcome back to the channel where we try to build long-term wealth by studying the markets and making informed decisions. And the market right now is not doing so well. We're down about 25% for the S&P 500, and as you can see, it's been a slow decline throughout the year so far. Unlike the previous market declines, like the drop in 2018 or the bear market in 2020, this one seems to be more drawn out, which a lot of people are not used to. Most investors are still much more bearish than bullish on the markets over the next 6 months. But despite all the bad news, I am actually very optimistic right now because I think there's a lot of reasons to be excited. So in today's video, we'll take a look at some indicators that will hopefully make you excited about the markets as well, and talk about where I plan to invest my money pretty much throughout the rest of this year. The thing to realize about the stock market is short term, it is run by traders. They decide if the markets go up or down. Traders react to noise, and if you're not careful, it's easy to get caught up in it. But it's really important to recognize the main catalysts and news. It's those important events that moves market over the long run. And as investors, we can safely ignore the noise and look at long-term metrics to help us determine where we are in the current cycle and where the stock market is likely headed in the future. There's no 100% certainty in any of this. It's all based on tendencies. But when you have a confluence of many different indicators showing the same thing, then it is very likely to happen. So looking at the AAII Investor Sentiment Survey, you can see a few weeks ago on September 21st, almost 61% of investors said that they were bearish and only 17.7 were bullish. Now, normally, because the stock markets generally go up, you can see that for the most part, there are more bullish investors than there are bearish, historically speaking. So to get a drop from the historical average of 38% bullish to 17.7, that is a huge drop. And at the same time, we're getting a doubling of investor sentiment thinking that the market will go down over the next 6 months. Now, this is almost a contrarian indicator because whenever we've had a lot of bearish sentiment compared to bullish in the past, it was pretty good at predicting a stock market bottom. So we can take that bullish percentage and we subtract the bearish percentage, which is 60.9, and then we get a difference of basically 43, which is a very extreme number. So that basically puts us right here, minus 43. And the last time that's happened was in 2009, where it dropped below minus 51. And soon afterwards, we've had the stock market rebound from the great financial crisis. So we're already looking at like the top 1% of the most fearful times since 1987 when this survey began. But even if you look at just the bottom 3%, which is a spread of minus 28% between the bullish and bearish sentiment, you can see the 3-month return of the S&P 500 after that was 3.8%, which is above average. And especially if you look at the 1-year, 3-year, or 5-year averages, you can see they are quite high. Now, obviously, it doesn't mean we're going to see this percentage difference number go up from here. We could fall more because it did fall to minus 51 before, as well as minus 54%. However, if we do go that low, I would not expect it to stay there because there's only so much bad news that can happen before there just aren't any more bad news. Here's another chart to show why I'm bullish. Over the last 70 years, whenever the S&P 500 fell 25% from its highs, which is the situation right now, the 1-year return after has almost always been positive, except for 2007, with the average return being 21.6%, which is above the typical return of the S&P 500 index in any given year. And again, when you look at the 3-year and 5-year time horizons after a 25% drop, you're looking at pretty outsized gains here of like 37% and 83%. Now, we don't have the numbers yet for the 3-year and 5-year periods for the 2020 recession, but at the lows of that market, the S&P 500 was at around 2,300. So for it to fall from 3640 today, we would have to fall by another like 35% or so. And I just don't really see that happening, which is why I think once we get into March of next year, this is going to be a positive number, and more likely than not, this 5-year after will also be positive. Again, we don't know what the numbers are going to be yet for the 1, 3, 5 years, but looking at this table, it is very likely that we are going to see green across the board. If we do see red, it's probably only going to show up in the plus 1-year column here. But if you have a 3-year time horizon, you can appreciate why it's enticing to want to invest in the markets right now. Because since 1950, every single time we've had a 25% drawdown the 3-year returns have not only been positive, but you also have better than expected average returns in those years. We can also take a look at this chart, which uses market breadth and basically tells us what percentage of the stock market is above its 50-day moving average. And this is the stock chart for Costco. And the 50-day moving average is just taking the previous 50 days and averaging it out to place a point at the current day. And then when you do this for many days and connect all the dots, you get this smooth black line here. So every stock will have its own 50-day moving average. So when we have a lot of stocks trading below their 50-day moving average, then at some point something has to give, and we're probably going to see the bottom of the market. So that's what this red graph is showing. And right now, as you can see, less than 10% of the names in the S&P 500 are trading above the 50-day moving average, which means more than 90% are trading below it. So the market is terribly oversold. And as you can see in the past, when we came to extremely oversold situations marked by this green line here, it pretty much marked a market bottom back in 2002. This one here. This one was the Great Recession. The percentage of stocks then went up, came back down to retest that green line. And that's the second dip over here, which marked the bottom of the market and the beginning of the next bull run. Over here in 2010 and 2011, 2012, where more than 90% of the stock market was trading below their 50-day moving average. And again, those marked relatively low points in the index. Same thing over here a couple times in 2016. You can see these events basically line up perfectly. Also in 2018, 2020, and right now we are at this position. If you look at 2009, even though we had this red chart go below this green line, that was only a bottom, but it wasn't the bottom. The bottom was the next time it fell below this green line. So that could be a situation right now where the previous low in June was this red line here, coming below the green line, and then we had it bounce up, and now we've had the market come back down in October, and we just crossed the green line again, which means the stock market is falling yet again. In fact, we reached a lower low than the previous June's low. So very similar to what happened back in 2008, 2009. So if we get the same situation, then we're going to see maybe the S&P 500 bottom out at around 3,500 or 3,400 before the absolute lows for this cycle is put in, and then we see a bounce from there. So this indicator doesn't tell us if this is the low, but what it does tell us is that it is a low. And that enough is useful information because when the market reaches this kind of oversold situation, bottom 2% of all readings, which is the situation we're in right now, you can see the forward returns of the S&P 500 after 1, 3, 6, and 9 months, as well as 1 year, and the returns after 2 years. And as you can see, these are very positive numbers. Normally, if you just buy the S&P 500 on any given year, on average, you're expected to make about 23.8% after 2 years. But in this situation, where only 7.8% of the stocks are trading above their 50-day moving average, in other words, like 92% of the market is trading below the 50-day moving average, then your 2-year return is likely going to be 49%. So that's more than double the normal expected returns from the market. Here's another study that says that after a 10% market decline, your 1-year, 3-year, and 5-year average returns are about 12%, 34%, and 69% respectively. However, if the markets are down 20%, you can see the expected 1-year, 3-year, and 5-year returns are higher. And this is the situation we're in right now. We're at about 25%. The market has not tanked 30% yet, so we are not in this situation. However, if the markets were to decline more and we get a 30% market decline, then a 1-year return of 24% almost. For some reason, the 3-year and 5-year returns are actually lower than the market just dropping 20%. But they're still both positive and still pretty good returns relative to a balanced portfolio. And this is from data over the last 100 years. And finally, this was just a tweet I put out last week with another study saying that if the markets are down 20%, here are the returns over the next 1, 2, and 3 years. And again, if you just look at the 2-year and 3-year historical returns, they are by and large very positive, with the average return being 29% after 3 years. And the likelihood that you're going to get a positive return is 89%. I think this is going to be higher once the 3-year return from the 2020 recession comes in. I think that's probably going to be a positive number here, especially when you look at the 1 year and 2 year returns. It's just very unlikely for the first and second year to be so positive, but then the third year it goes negative. We would have to see a massive drop in the stock market, and it's hard to see a situation where that might happen. So the idea is, I don't know what the stock market will do in the short term, but if I just hold my stocks and if I buy more, then I know that in the next 3 years, it is very likely that I'm going to get a return between -6%, because that's what happened in 2001, and 62%, which was in 1982. So it's possible I could get a negative number, but I know the average is 29%, so I am willing to take those chances. So the reason I'm optimistic on the markets is because since it's gone down so much, investors are likely to see very positive returns over the next 3 years. And buying the S&P 500 or a total stock market index is one way to go about it. But what I'm doing right now is looking at high quality companies and I'm dollar cost averaging into those. And specifically, I'm looking at growth stocks. Here's a graph showing the different types of stocks in the markets and their historical returns. And right now, we're at one of these lower points in the stock market. This chart only goes up to the end of 2021, so it doesn't show the decline we're seeing for this year. But right now, we are looking at one of the lower points, like at the end of 2018 or the beginning of 2020. So at this point, would I be investing in like an international ETF? Or developed market ETF like this red and green line over here? Probably not, because as you can see in a recovery, they don't do as well as some of these other segments of the stock market. And the one that should outperform the most is this blue line here, which are growth stocks represented by this Vanguard Growth ETF. So that's why I'm looking at strong companies, dominant players in their industries like Amazon, Google, Microsoft, Salesforce, as well as other growth-oriented stocks that have been down a lot this year, such as AMD. They're down 61% year to date, and it looks like they are still falling. So I am buying small amounts of these companies on days where they fall, knowing that they could fall further, but also knowing that in 3 years' time, it's very likely that they are going to be much higher than their current price today. So hopefully that gives you some perspective on where we are right now in the market cycle. As long as you have a 3 year investment time horizon, I think this is definitely the time to be a net buyer, and definitely do not sell, especially if you have long-term conviction in the current stocks that you're holding. Commodity prices are falling, inflation is likely going to slowly come down, interest rates will eventually stop going up, and it's only a matter of time before we see the bottom of this market. So if you just focus on the next 3+ years, you can skip all the noise in the short term, and you can make the right decisions to capture those long-term gains by making a plan and taking action today. So I hope that makes sense, and that's why I'm excited about the markets moving forward, especially over the next 3 years, but even over the next 1 or 2 years, it's still likely that we're going to see not just positive returns, but very positive returns. So that's why I'm optimistic. Anyway, thanks a lot for watching, and I'll talk to you in the next one.